Lori KO 5939 asked, can you explain what is happening on February 15th for silver owners and how we can fight it as stackers? The privacy is going away and they want to track every ounce we buy and sell. Well, the reality is that's what the whole world wants to do. The question is, are we going to fight? But we'll just stick with this for the moment, because on February 15th, there are new reporting rules that kick in that directly affect those silver stackers in Canada. And, you know, what goes in one place, happens in one place, does not stay there. So it's important for all of us to be aware of. Dealers will be required to report large cash transactions, which they already are in the U.S., verify identities more aggressively, and flag anything they consider unusual. So it doesn't actually make silver illegal, but it does mean the privacy that stackers have relied on is being eroded. So every time you buy or sell through a dealer, more of that information flows into a centralized system. Now, let's just take a look at the bigger picture. The Bank of Canada holds 0 gold, not a single ounce in reserve. That means that if confidence in the currency slips or the financial system hits turbulence, the government has no hard asset buffer of its own. So I did look in there, and there has never been a Canadian overt confiscation. However, they also don't own gold, and that makes it a little risky, because when governments lack reserves, they become far more interested in the hard assets that are held by the public. So while I can't say that confiscation is happening, and again, Canada has never overtly confiscated gold or silver, but structurally, the pressure increases when the state has none and citizens have plenty. And I want you to just remember that the transition that we're in right now, that reset from this one system into the new system, well, we've never really gone through this before. This is different than when we went through the transition from a gold standard to a debt standard in 1971, because they need to reinvigorate the entire fiat currency system. And what they really have to do is they have to do that overnight revaluation, because gold is the most trusted collateral without any counterparty risk. So keep it in mind. And, you know, I mean, it has been happening here in the U.S. for a very long time. Having said that, I want to let everybody know that at this point in time, we are not legally obligated to report any part of the transaction. This would be true on American Eagles. It's 100% true on the collectibles. So just keep that in mind here in the U.S. But what do they want to do? They want to digitize everything so that it can be used for collateral, and they can track everything, the buys and the sells. This is why we have to come together on a global basis and demand our rights back. Because otherwise, we're slaves. That's it. We're slaves. You have to ask yourself, is that okay with me? If it is, don't worry about it. If it's not, then come together and let's get redeemable gold back in the system. Okay, Mr. Petteroni 1 asked, is it possible for gold bullion to be confiscated even if you hold it in a different jurisdiction? As a Canadian holding American Eagles instead of Maples, does that reduce the risk or might be a good exit plan? And, you know, I get this question a lot, whether holding gold or silver in another jurisdiction or in another jurisdiction's form protects them from restrictions at home. And the truth is this: governments regulate based on citizenship and residency, not the mint or the stamp on your coins. So if a country ever imposed controls on bullion, it wouldn't matter whether you held Maple Leafs, Eagles, Philharmonics, or anything else that is bullion. Bars, Bullion is bullion, and holding it offshore doesn't eliminate the authority your home country has over its citizens' financial assets, let alone holding it in your country, just a different form of gold, American Eagle versus Canadian Maple Leaf. But you know what? Here's the real takeaway. Because history shows that when governments tighten control, they target the monetary metals, not the collectibles. That's why our sound money strategy is based on the collectibles market. But I just finished a video, I don't know when it'll be coming out, on the different ways that you can hold gold and silver, which is why you see all of this stuff here on the table. And I want to remind you, yeah, you can stack bars and you can stack bullion, you can stack all of that, but you can also have a very diversified portfolio that includes what we could hold even when you couldn't. So the collectibles of all kinds, right? They have layers of protection that bullion coins do not have. That's why it's critically important for everybody to understand the true fundamental value. How much is this stuff really worth in terms of dollars or euros or wherever you happen to be in the world, in terms of that currency? What's its true value? Because that's where it's going. I can't give you a whole lot of guarantees, but I can guarantee that I will show up and I will do the work. And I can also guarantee that at some point, all assets go to their true fundamental value. I did a little experiment because I bought this when I was in Malaysia and Cambodia, and it's a sterling silver belt, right? And the workmanship on it is really beautiful. And I happened to wear it yesterday for the first time, and I thought to myself, you know, I bought this, when did I go? It was like the end of September, so before the big run on the spot markets. And at that time, I think I paid like, I don't know, $300, $325, something like that for the belt. So I happened to wear it yesterday, and I thought, I wonder how much this thing weighs, because I never weighed it. But I did, and it weighs 10.7 ounces. That means that what took me, you know, $300 or $325 to buy in September is now just the monetary value of it, worth double what I paid for it in terms of fiat, without this extra layer of protection, because it's a collectible, isn't it? I want you to keep this in mind. You know, I always have my forks and all of that over here, because gold and silver in any form is monetary at its base. So once you become clear that the true fundamental value of an ounce of gold at this moment, before more money printing, is somewhere between $38,000 and $40,000, and the true fundamental value of an ounce of silver before they do anything else is somewhere between $1,800 and $2,000, then if I paid $350 for it, what difference did it make, right? Just like my necklace that you see me wear that I bought back in 1987 when I first moved here for $350. You know, and the latest appraisal was $6,500. Just the gold content weight, I turned it off. Give me a 0. Just the gold content weight of that is 1.6 ounces. Do you see what I'm saying? It's not that gold is going up, it's the value of the dollar going down, and gold and silver in any form will hold your purchasing power intact. It's the way that you hold it and the variety of ways that you can hold it. So the strategy isn't switching mints or crossing borders. It's stepping into forms of metals that give you insulation, privacy, and control, no matter what jurisdiction you're standing in. So Daniel Mastrocco last week said, I'm curious what the 5 gold confiscations in the U.S. government has done. Google doesn't provide the results. Maybe you can make a short video on that. And that's what I'm doing. So these are, and actually when I went back and I kind of looked at the definition, again, I'm wrong. Right? It's not 5 times, it's 7 times. And I'm also not just looking at the overt confiscations, but the currency revaluations. And I didn't have those in my list. The two, oh, did I say this? The 2 that happened in 1973, the first one in January, which was just under 10% revaluation, and the one in February that was just over a 10% revaluation. They did it in measured strokes so that you and I, well, those of us that were around then, didn't really notice it too much, except I can tell you, I remember the inflation that was happening during that period of time a lot, something about 45%. So I think it just missed the hyperinflation definition of 50%. But here they are. In 1812, contracts that were invalidated and the mints were closed. In the 1860s, the government went further by physically confiscating gold and voiding private contracts. In 33, citizens were forced to surrender their gold, and in 34, the government revalued it overnight, capturing 40% of the public's wealth with a single stroke. And guess what? Based on all the money that they created up to 33, they should have done it to 42.22, but they knew that the public wouldn't be able to tolerate it. So we started out, even after the revaluations, in a deficit. In 1971, convertibility for other governments was cut off entirely. That was a Bretton Woods default. And, you know, I never really thought about it as a confiscation, but it was totally a confiscation because foreign governments that were holding their gold here with the promise that they could exchange dollars for gold anytime they wanted, that was the default. Right? Because we said, nope, you can't do it anymore, which means that the U.S. confiscated the global gold. And by 73, that gold was revalued twice more. So understand this, the pattern is unmistakable because, let me show you this. I thought, well, here's just a list of all the times just since, well, I think we go to 1812, the number of times and the different countries that have done overt and reasonably covert confiscations. You know, the pattern, right, during wars, depression, currency instability, the government protects itself first, right? They flip-flopped the Constitution, where it used to be that the individual was the head, and then the states were supposed to support the individual rights, and then the federal government was supposed to support the states who were supposed to support the individual rights. That's been flip-flopped. And you need to understand that it's not always through overt seizures, sometimes through revaluation, for bans, for forced sales, inflation, taxation. At the end, the result is the same. Citizens lose their purchasing power if they believe the lies. And we know, how many times can you be lied to and you do not know the truth? History doesn't repeat perfectly, but it rhymes. And every rhyme points to the same truth. In a crisis, gold moves, governments try to move faster because whoever holds the gold holds control. So I hope that answered that question. Now let's get to the technicals, because I want you to think of the global financial system as a long line of dominoes. Some are big, some are small. You know, at first they're all standing upright and they're all connected. What is happening in the metals market right now is a problem. It is the first big domino. And remember, we've been talking now for over a year about the transition from the paper markets controlling the prices to the physical markets. What we're talking about here, because people are going crazy. There's so much volatility in those spot gold and silver contracts. They are contracts. The physical markets do not move that fast. But look at this. This is a trader who made billions on gold contracts, suddenly betting against silver, meaning selling it short. That's not a casual move. That's a heavyweight leaning in, using the leverage of the paper contracts. And when someone with that kind of track record shifts their position, it's going to matter. And it's because they can feel the instability and they sense the wobble. They know that the dominoes are closer to falling than anyone wants to admit. And remember, silver is the fuse. It straddles both worlds, so it's a lot more volatile. But this trader, he's not reacting to physical silver. These physical markets, they just do not move that fast. He's reacting to the paper market, a leverage contract stacked so high that they're swaying. That's what we're seeing right now. It's really so interesting. And you know, when one big domino tips over, it doesn't fall alone. This shows you what happens when the pressure spreads from a single trader to an entire government's central counterparty intervention. They had to, because it threatened the entire very fragile paper system. It's political weight, because when a government steps in, especially one as large and influential as China, it means that the position is big enough and the leverage is heavy enough that it threatens total stability in all the markets. This isn't about ounces of silver. It's about those contracts. Short, hello, see, she wanted to come in and see it. Hi, baby. But shorts are selling something that you don't own, and then you anticipate that pushing down the price so you can go in and buy it cheaper, and then you earn that difference between what you sold it at and what you go in and buy it at. But what I really want you to understand as well is a lot of this are naked shorts. So where a short position, you might be short against the box, it's called, against the box, meaning he's got the physical silver over here, but he shorts the paper contracts. That means that if you had to, you could go in and deliver that out. But this position was so large that this was considered a naked short, which means there's no silver that can be delivered. This is huge because, again, once a government intervenes in a short position, it tells you that the paper side has grown too large relative to the real metal underneath. Now the dominoes, they're leaning harder and they're leaning faster. And frankly, they're leaning in one direction. So let me show you, because once political weight hits the line, well, then what is it? The next domino begins to lean, and that's the gold contracts. Contracts. Let's look at how that paper market is tilting the biggest piece in the chain. Let's see. Oh, spot gold. This is a spot gold contract. Okay. What I also want to show you in here are the technical moves, because on 2/6, we were at 49. So I just did this. What's today? Today's the 10th. Okay. So this is, I pulled from Friday, and you can see that big, huge correction. Now, I want to remind you, first of all, that the distance from that 50-day moving average that we've been talking about now for quite some time is 9.45. 10% is a lot. So it's still a lot away above that 50-day moving average. But the 200-day moving average is still 37.38% away. That is extreme. That is showing a massive divergence from its long-term trend. It's not spot gold drifting higher. It's tilting, it's leaning far above that 200-day moving average. And that kind of move doesn't come from the physical part of the buying, though we are, and I cannot wait until it's complete, but it's not complete yet. That transition from the paper markets dictating the visible price to those physical markets dictating the true supply and demand price. What you're looking at in the paper market are futures, options, swaps, unallocated accounts. You're looking at shorts and naked shorts and all sorts of things. Leverage, leverage, leverage. And leverage means you got a teeny weeny bit of equity and lots of debt on top of it. That can topple the whole entire system. Remember, 2019, I don't know exactly where it is today, but according to the Bank for International Settlements, for every 1 physical ounce of gold in any form that existed, there were 64,000 ounces of digital gold. And that was 2019, before the party really started. So keep that in mind, because when gold stretches this far above its trend line, it's not because the physical market is tight. It's because the paper market is unstable. The contracts are wobbling. The leverage is swaying. And gold, spot gold, the biggest domino in the line, because it's a paper contract, it's starting to lean. And there's your volatility. It does not mean that it is overvalued. Nothing goes straight up. Nothing goes straight down. You get bouncing along the way. And I've shown you this before. Markets can stay irrational a lot longer than you would ever think possible, but they can. However, they could just be staying in this range, giving that 200-day moving average a chance to catch up. That's the technical part of it. But frankly, if gold is leaning, silver's racing, because it's the smallest domino in the chain. It moves the fastest. And this next slide, whoops. Yeah, this is not ready yet. Sorry, I'm a little ahead of myself, but you guys will forgive me. Because you asked me last week where was support, so that's what I pulled. So you can see, and all you have to do is pull up any chart and pull up a ruler or some kind of straight edge and start drawing lines, right? So you can see the support on spot gold is at about 4,400. That's the first line. And then I did another one because remember, once a support on the bottom line is broken, that then becomes the resistance on the top, okay? So the next support line below is 3,900, and you could just see where it hit and then it bounced up. And then this last one, which I do not think we're going to get to any one of these levels. Maybe 4,400, but you asked me where the support levels are. That's why I'm showing you this. And you've got a ton of support, a ton of it at 3,450. So on spot gold contract that does not reflect the true fundamental value, there are your support levels as requested. Now we're looking at spot silver, and spot silver has closed below that 50-day moving average. So I didn't log that because that's okay, but the distance from the 200-day moving average is still extreme at 57.45%. 10% is a lot. So that is an extreme long-term trend or long-term breaking. And it shows that an even more extreme divergence, more than 50% above its 200-day moving average. This is not the physical world. This is the paper world that I was just showing you with lots of shorts and traders and going back and forth. They don't give a crap about the true value of gold or silver. They just care about the little bit that they make up in between. And these kinds of moves in both spot gold and spot silver, they're very rare. It doesn't happen in calm markets. It happens when the paper side is overloaded, and we are in this transition right now as you and I are talking. And it is the most leveraged metal in the system. The paper claims, I can't even determine what they might be because they're buried in so many different places. And when traders place those big directional bets, right, then governments intervene when they go wrong because they're too big to fail. But you and I, we're just the right size. So let's take a look at the support levels in spot silver. The first one that I find is 59. And it doesn't mean that it's going to go down to that, mind you, but you asked me where the support is, so I'm showing you. We've got a support level at 59. The next one below that is 55. And the one below that is 39. Do I think that we're going to get to the 30? No, I think those days are gone. Long gone. And that's just fine. Do I think that it can test it? Yeah, but it can stay in this range, giving that 200-day moving average an opportunity to catch up. So I think that's all I did. Nope. I did one more for you guys because you keep asking me about the gold-silver ratio. So it got down as low as 44.14 to 1 on the 25th of January. And as of 2/5, February 5th, it was at 64.39. Now, I don't know if this is the divergence that I've shown you before, because remember, as we're going through the reset transition, for a while, since silver is the fuse, gold is the anchor, right? So for a while, that silver-gold ratio gap closes, and then we get to a point where it's recognized that the hyperinflation is in play, and then it broadens again. I don't think that that's where we are yet. I think this is just technicals working off a severely overbought scenario. So we'll stay tuned, and I will let you know when I see things changing, or when you ask me more questions, and I'll dig in and do it some more. But thank you for being here. I really appreciate it, and I know we can change the world together. And why not do that? How about we all just make a really positive difference for a lot of people? And until next we meet, please be safe out there. Bye-bye.